you can use that additional equity as a deposit towards your next car, in that you have no additional costs for running that car for the duration of your salary sacrifice period. But it is a very, very good way of leveraging equity in your home to be able to make a purchase. Neither the T-Junction or any representatives are registered with the Financial Conduct Authority, the FCA, or any legal bodies, and therefore cannot give you legal or financial advice. Any information contained in this episode is merely for information and education. If applicable, the sources of this information can be found in the description of this video and any other future videos. Hello there and welcome to the T-Junction. I'm Jats, and in today's top tips video we are looking at financing and funding cars. Now I'm going to give you the top 8 here. So number 1, you can borrow the money. Now sounds quite straightforward, doesn't it? It could be a hire purchase agreement or it could be something like a bank loan. Hire purchase is slightly different to a bank because the HP amount, the hire purchase money, goes straight into the account of the retailer or the dealer that's actually selling you the car. So they will draw down the money goes into their account, the car is handed over to you, you make monthly payments, and at a certain point within the life cycle of that HP agreement, the car will become yours, but you must continue to make the financial payments, obviously. With a bank loan, it's slightly different because you've agreed that with your bank. The bank will put the money into your account and you are then free to buy a car, or you might have agreed or decided that you want to do something else with the money. But the money is yours, it's tied to you, it's not tied to the car necessarily. And of course, it could be tied to your mortgage, to your house or something like that. So that's one of the things you can do. Now, talking of mortgages, it's one of the things that people don't tend to do. So number 2 is borrowing the money against your mortgage. Now, as I say, a lot of people don't consider this, but it is a very, very good way of leveraging equity in your home to be able to make a purchase. And it could be an extension, or it could be a patio, or it could be buying a new car. Now, when you talk to your mortgage company, they will give you what the options are for each of those. And the interest rates, generally speaking, or certainly from my experience, have always been reasonably good. Now, again, I'm not FCA registered. I can't give you financial advice. All I can do is share my experience with you. And you should really use the information that I'm giving you as education or information. Feel free to use this information to go and question or quiz your lender, and always make sure that they are FCA registered. So they are registered with the Financial Conduct Authority. You can find the link in the description of this video or just here. And please use that and make sure that the Financial Conduct Authority registration exists for that particular lender. Number 3 then is credit card. Now, again, credit cards are something that you might want to use, you might not want to use. We tend to use credit cards as a short-term purchase mechanism. Credit cards can be a good way of actually giving you protections that you might not otherwise have. So just as an example, we've got a video coming out fairly soon, and as soon as it's out, I will put the link to it in the description of this video. But we are looking at the Consumer Credit Act and how that impacts you, and the benefits and advantages of actually paying for a car either fully or partly with a credit card can be quite useful. So it's just one of those things that you might want to consider. So credit card is number 3. Number 4 is a personal contract plan or a personal contract purchase, a PCP. Now, the way PCP works is a little bit like getting HP. What you do is you agree the price of a car with the dealer, you pay a deposit, they might make a contribution as well towards it, and then you have monthly payments to make. Now, those monthly payments and any payments that you're making will not include what they call the balloon payment or the final guaranteed value or the guaranteed future value. There's so many different names for it, but essentially they're the same thing. What they are is a value of the car that they've already predetermined what the car's going to be worth at the end of that agreement. And what they will do is they will put the agreement together in such a way that you're not paying anything towards that final portion. So what you're doing is you are paying just the depreciation on the car. You're not making any payments towards that balloon payment, if you call it that, until the end of the agreement. And then at the end of the agreement, you have a choice. You can either make the balloon payment, take out another loan and pay that balloon payment off slowly, do whatever you want to do with that balloon payment, whatever's appropriate for it at that time, or you can hand the car back. Now, if the car is depreciated, so let's just say as an example, there's been a change in the economy and you'd bought a 4x4 and it was no longer worth even what the guaranteed final value of the balloon payment was worth, well, then it doesn't matter to you because you can walk away from it. But if the car is worth more than the balloon payment or the guaranteed future value, you can use that additional equity as a deposit towards your next car. So it can be quite a useful way of doing things. And again, it all comes down to personal circumstances and the agreement that you've signed. It's a very popular way of buying cars. Number 5 is leasing, or personal contract hire, as dealers tend to call it. Now, leasing is a little bit like hiring the car, and that's it. So what you're doing is you're hiring a car and you're going to pay a monthly fee. There's normally a small deposit to pay up front, and then that's it. At the end of the agreement, you hand the car back. Now, some leasing companies will allow you to, well, effectively extend the lease at a slightly lower cost. So you might be able to have a 3-year lease that you can extend by a further couple of years. Not all of them do that. Some may not. Leasing is a way of hiring a car rather than buying a car. Now, dealers call it personal contract hire. Same thing, essentially. Just that the dealer's doing it rather than you going through a broker or through a lease company. Now, usually lease companies can be cheaper, and it's definitely worthwhile shopping around, because lease companies or the brokers that do the leasing, they tend to go directly to manufacturers or straight to dealerships. And they can usually try and find the car at the cheapest possible price. So whereas you might be going to your local dealer, they will have national reach. Number 6 is subscription. Very similar to leasing and personal contract hire. The fees, the monthly charges, are normally higher, but what they do is they allow you, they allow you to change the vehicle, so you can actually upgrade or downgrade. So let's just say your circumstances change, and within 12 months of going into a lease deal, you need to get out of that lease deal because you need a bigger car or a smaller car. Well, subscription models allow you to do that. But as I say, subscription fees tend to be higher, but they do give you more flexibility. Number 7 is salary sacrifice. Now, this is something that applies to electric vehicles and hybrids generally. It's a government-led initiative. What happens is your payments for the car come out from your salary before tax and before national insurance. Salary sacrifice schemes tend to include things like insurance and maintenance, or one of those things or both of those things. So it can be quite useful in that you have no additional costs for running that car for the duration of your salary sacrifice period. And then finally, of course, number 8 is cash. Cash, there's no contracts or anything like that to sign. The car is yours the minute you buy it. Now remember, a car is a depreciating asset, so for every pound that you've put in, you're likely to get less back. So putting all your money up front into a car, especially if it's a very expensive car, it's something that you might consider doing, it's something that you might not. You've got to make that decision and go into it with your eyes wide open. Neither myself or any representatives of the T-Junction are registered with the Financial Conduct Authority, so I can't advise you on which is the right option for you. It's something that you might want to go away and look at and talk to somebody who is FCA registered before you sign the deal. Now, if you can think of any other ways of financing cars, then please do let me know. I'd love to know, really, if you find a different way of doing it. We do also have a podcast on financing new cars, which you can find by following the link just here or in the description of this video. So with that, I leave you. I say thank you for checking in. Thank you for watching. If you haven't subscribed to this channel, please do so. If you like this episode, please hit that thumbs up icon. I will catch you on the next one.